The following is a presentation of TFNN. It is now time for Trade What You See with your host, Larry Pesavento. Call now, toll free at 1-877-927-6648. Internationally at 727-445-1044. Now, Larry Pesavento.
Okay, good afternoon, folks. And I'm going to start out the show with the IBB, the Biotech Index. The reason why I think it's so important is if you'll take a look at this chart in Tiger TV, you'll notice that the low that we made back on last Thursday was an exact 61% retracement of the low from February 3rd. So it's already broken below the really key date of March the 11th to 13th, that week's lows. It had multiple lows in there between the 11th, 12th, and 13th, but we'll just use the 11th as the key date because that's the whole picture. Because that, if we take out that low from May, let's try it again. If we take out the low of May 11th, that's equivalent to us taking out the low of August 15th of 2007. If you'll remember, that made a really sharp low that day back in 2007. The Dow was down over 300 points that day. The Russell index was actually trading higher when the Dow was down 300. From there, it went up into October. October 7th, it's made its high. Then we broke below that August low about 2 or 3 weeks later, and the market just totally came unglued. And I believe this bull market's intact until we take out that March 11th low. We took out that low with the Dow Jones futures and the Dow Jones, with the Dow Jones futures, the S&P 500 futures. We did not take it out in the cash market, so it's still valid. The New York Stock Exchange Index, which is the one that I use as the gauge of what's really happening in the markets, is the really key one, and I'll put this one up so you folks can take a look at it, because we made a perfect 61% retracement last week, and that was the key that tells us that, you know, this market still has legs, and it looks like it wants to, to continue higher. The problem is where we're sitting right now, we're having a pretty good rally in stocks with the Dow up 250 or plus points, but the thing is that we are in the overall stock market, we are below our highs of July by a significant amount, better than 2.5%. That tells me that this, bull market has just basically been, 531 stocks that we've talked about before. And a perfect example of that is what happened to us on last week. Last week, we took out the lows of March 11th in the futures market because everything was much weaker, whatever the excuse was, but we took out those lows, but we did not do it in the real market, the cash market for the S&P, the Dow Jones, or the NASDAQ. But most importantly, it was a New York Stock Exchange Index that made the 61% retracement last Thursday and held up at those levels, and we're a little bit higher today. So it appears that we're still moving higher. This is the last 5 trading. Let's try it again. The last 2 trading days of the month and the first 3 trading days of the month are the most positive days of the whole year. Just watch those because those are the days that really, really count for an up move. And of course, we're in our second day of that, so we should get a rally into Wednesday. Now we have a holiday week, and it'll be shortened a bit, so I don't expect a whole lot of activity. I was listening to Basil's show, and to hear the gentleman who's been leading us forward in this market, along with Steve Rhodes and Tom O'Brien, since 2009, to see him start issuing cautions, everyone should pay attention to that, because his technical work stands by itself. And we are getting ready for something really, really big, folks. My personal opinion is that it's not going to be the stock market that gets the full brunt of this. I believe it's going to be the debt market, i.e. corporate bonds. We issued up to $7.7 trillion in Treasury bonds. Let's try it again, Larry. $7.7 trillion in corporate bonds over the past 5 years, and most of that has gone into buybacks. So, which is simple, because if you got interest rates very, very low and your stock is, is making a lot more than what the interest is, it's better to buy the stock back than to, to just let it linger there. So that's what probably it is. Of course, they get paid on their bonuses with stock options, so that also makes common sense. But that's where the real bubble lies, is in the debt market. We've been going down in interest rates for 32 years now. I believe that is about to stop. However, we don't know how far it's going to go down, or how much farther it's going to go up before it does. I wanted to give a little summary here on the junk bond market here, because that's another one that looks very, very interesting. You'll notice that the junk bond market is really making a very, very wide divergence now between the 30-year Treasury bonds and the junk bonds. So that's telling us that people are starting to move to quality just a little bit. But we were only able to make a 61% retracement on these junk bonds after we completed that big pattern to the downside last week. So the real key here is the debt market, folks. That's where the real, I know we all love the S&P and the NASDAQ and the Dow Jones, but the real problem is going to come in the bond market. I don't know when it's going to happen, but history says that it's going to happen. What these quantitative easing folks have been doing in Europe and the U.S. and China and also Japan is basically they're extending credit card debt. There's really no difference in what they're doing, is to try to, if you pay off one credit card with another credit card, and that's just keeps going around and around like musical chairs, and finally someone's going to be standing when the last chair hits. When that happens, we'll have to wait and see. But this is not going to end well. That much I feel strongly about, just because of the fact that this has never been tried before. It's a giant experiment, and these fellas they've pushed it to the limit. They've taken the cycles and they've moved them out to areas. We used to have a 48-month cycle in the stock market, and that has shifted. We haven't had anything now since 2009, so we're 1.5 cycles past where we should be for a pretty good pullback or recession in the market. But when this one comes, this is going to be it'll set the record, that's for sure. Whether it's going to set the records on the downside or the upside, we'll have to wait and see. I would not be surprised to see a blow off top in stocks. I certainly wouldn't be surprised to see that. This is the one thing that this market has not had, is a blow off top, and we could still see that is, that's say that someone asked a question, why can't this bull market go on for years? I guess it could go on for years, but history says that that's not the way it's going to be. But we'll have to wait and see. And remember, you couldn't get anybody to buy stocks back in March of 2009. And now the whole world is bullish. I mean, we have the highest bullish consensus we ever had. We've got the highest margin debt we've ever had. None of that is kicking in yet. That doesn't mean that it's not working. It just has not kicked in as yet. You can't fight the technicals. And, like Basil was saying, and also Steve Rhodes, is this market has a bullish bias. I mean, just, these next few days from Thursday, Friday, Monday, Tuesday, and Wednesday this week, that's pretty much. And not only that, but we have a holiday, and the day before the holiday has a 70% chance of being bullish. So you've got these last 2 days of the month and the first 3 days of next month all has a positive bias. That's all. When I look at these things, folks, I'm looking at historical norms. That's all I'm looking at. Going over the last, I've been studied the stocks very, very strongly since 1875. That was 2 years after I got out of high school. And so with that kind of, you got 145 years of experience in there looking at these different patterns, just tells us where we are. And this has got to be a big one. Just like the one in March of 2000 was, it was a perfect buying pattern. I mean, everything in the world was saying buy, and we are getting into the point here where soon everything is going to be yelling sell. The one thing that I wanted to go into, but I will after the break here, because we've got a break coming up here in a couple minutes, and you'll be someone made the comment that I'm depressing the bears. No, I'm not. I'm just telling you what I see technical. You know, when that market held on that March 11th low, that was such a critical low, because that goes back to the lows of 1982 and also 1974. In other words, it fits with the pattern of these things, and that's what's really important. These patterns are all based on that Fibonacci spiral that we see in the galaxy and stuff. It's also shown as the chambered nautilus, where the spiral keeps going around. And if you ever watch any of the history channels where they look at ancient civilizations going back to Mesopotamia and the Babylonians, Sumerians, and 10,000 years BC, there's one pattern that sticks out on all of these hieroglyphs that they have, and that is that Fibonacci spiral that is basically what our cosmos looks like. And so that's all we're looking at with these patterns. And then sometimes they fail. They certainly do. But historically, it says you're going to have a pretty good probability of a major top sometime here in April, usually around the third week of April is what I'm looking at. But we'll have to wait and see if it's going to be a blow-off top. And some of them will probably not be making new highs, like the transportation might not be making new highs. Utilities might not be making new highs. But you know, there will be one or two in there that'll probably go crazy, and it's most probably the NASDAQ. You know, maybe it's Apple going to come out with their watch in a couple of weeks, and maybe it's going to be standard equipment for everybody over the age of 12. I don't know. But the one thing this market has not had yet is a spectacular blow-off where everybody, including myself, throws in the towel, and it looks like stocks are going to go straight higher, and that's when it'll most probably turn around. We'll have to wait and see. Okay. We got the Dow Jones is still strong, where it's up a couple hundred points. Gold is selling off quite a bit, which is not unexpected, because we went up to that 1220 level, which should have been major resistance, and silver hit the exact 61% retracement. So we'll have to watch this pullback here that we're getting in the gold, because I believe if gold can hold that 1170 area on this pullback, we're trading at 1180 and change right now. Another $10 to $15 lower, which should be pretty good support in gold, and then we'll find out if it really has the possibility of doing it. The rally that we had in gold on Thursday was nothing more than a 786 retracement of the, 50% retracement of the previous high, and silver had made the 61% retracement of the previous high. So we'll be out. We'll be able to watch what they're going to be doing on these next pullback over the next few weeks. We've got a major crop report due Tuesday, so we'll be talking about that on Wednesday. 877-927-6648. The Dow's up plus 250.
Trade with confidence and clarity while using the software that thousands of institutional traders rely on to make the best and most accurate decisions. Choose from 1,000 equities, currencies, and futures instruments utilizing the TAS architecture. As seen on Bloomberg terminals worldwide, the TAS Profile Scanner is a benchmark technical filtering system that thousands of traders rely on, and now you can too. For a limited time for TFNN subscribers only, we've reduced the price to just $97. That's over 75% off. John Logan hosted a special subscriber-only webinar in December, and you'll gain access to that archive as well, so you can learn exactly what the TAS Profile Scanner can do for you. Try this product out. No matter what you trade, the TAS Profile Scanner can help you make more informed trading decisions. There's no obligation to pay anything. Don't let this offer pass you by. Get your 30-day free trial to the TAS Profile Scanner today by signing up at TFNN.com.
TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartlys, ABCs, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com.
Platinum, grains, crude oil, gold, copper, cattle, hogs, gasoline, natural gas, coffee, cotton, cocoa, and sugar. These are just some of the commodities mentioned in the most recent issue of Andy Hecht's Techno-Mental Commodity Report. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Techno-Mental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you will lock in the low rate of only $79 a month. Sign up right now for the Techno-Mental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com.
You take a hands-on approach to managing your investments, and whether you're bullish or bearish on Chinese stocks, the ETFs from Direction Shares are there to help you magnify your perspective. Bull ETFs for a rising market and bear ETFs for a falling market. Direction Shares gives you the tools for both sides of the trade. Discover how we can help at DirectionShares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction Shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor Foresight Fund Services, LLC.
Larry takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
Okay, folks, we're going to take a look here at the Treasury notes. We talked about that last week. About a potential sale up at that 61% retracement at 129 and change. That was 129.05. We're now trading about a half a point lower than that, which means that at least it started to work. But the key here is the shooting star pattern that we had at that particular time that we talked about. And if you'll notice on this chart, you'll see the other times where we've had that shooting star pattern, and that's the type of thing that we're looking at. The basic trend is, we made lower highs now than we did back in January. So there's a possibility now that we're getting ready to have a sharply higher increase in interest rates. I know the whole world doesn't think that can happen, but the Federal Reserve, God bless them, might do something to surprise us. If you'll remember back in 1996, right in the middle of the trading day, our good friend Alan Greenspan came out and dropped rates 0.5%. The S&P gapped 50 handles. It went from basically where we're trading now, let's say at 21.10. The next trade was at 21.60, and it bankrupted over 30 CME traders at that time. So that's the type of thing that you don't want to see happen, but it could happen. Yeah, there's a lot of things going on in the world, not just with the possibility of war in the Middle East again, which they've been fighting for 3,000 years, so that shouldn't have too much of an effect. But there's going to be other factors. This debt cycle that we have, folks, is going to end very badly. I don't think there's any question about that. One of the best books I've ever read on investment was Bernard Baruch's book, his autobiography, My Own Story. And the key to that book was that you want to be saying that you don't want to be Let's try it again. Bernard Baruch said, don't be concerned on the return on your money. Be concerned on the return of your money. And that's what's happening now is people look at what their returns are, and so they go into riskier investments like junk bonds and things like that to get their investments up, but they're forgetting the quality. The problem is as the cycle continues to go higher and higher with lower and lower interest rates, people don't stop and think about what the risk is of something that we're looking at. So that's the overall key to what's going to happen. I believe it's going to be the corporate bond market that's going to get hit probably the hardest, with the lower class junk bonds. The Class C and B bonds will be hit by far the greatest. And as you can see, that chart that I posted into junk bonds is that we made our high well over a year ago, and we've been going steadily lower in that all the time. So just keep our eye on the prize. We'll know it when it happens. When the bond market, the corporate bond market, starts to tremble, believe me, the tremors are going to be felt on the New York Stock Exchange, the Nasdaq, and the S&P 500. So that's what. Keep in mind that we're looking at. And also remember that Basel is in there giving some warning signals. So, you'd enjoy this as long as it stakes, and then we'll see how it's going to end up. But when it does turn over, there's going to be a lot of money to be made on the downside, and it'll be made a lot faster on the downside than it was on the upside. That because fear is a greater emotion than greed, and that will tell us that we're basically looking at it. I've had a question about that March 11th date, why it's so important. There's so many things related to cycles and Fibonacci about March 11th that I really, I couldn't do them all in probably one show, and most people wouldn't understand it anyway. Just keep in mind, watch March 11th, what happens, because if we go below those lows, we're looking at something incredibly bad, and it could even have a crash scenario, which would not surprise me at all, because we've had virtually no corrections in this market since 2011, back in July, when we had that big combust cycle, and we had an ABCD pattern at the 382 retracement from the 2009 low. So it's just been straight up, for 5 years, making it one of the strongest, not the strongest bull market that we've ever had in stocks. And remember, it was coming off the 2009 low, which, that was the end of the world. We had our congressman being, blackmailed because the banking system was going to shut down unless we saved our banks. And sure we did. And now what are the banks doing? They're making record profits. I think the best executive of the year for CEOs should be Jamie Dimon. They had $16 billion in fines, I believe, over the last year, and yet he still got a $4 million bonus. You can't beat it. Okay, we'll be right back. We'll have our first caller from Philadelphia when we get back.
Has the current market volatility continued to stop you out of trades when the market spikes against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a brand new, completely regulated Chicago-based exchange, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their completely free trading platform, which also features real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped, and you have the ability of keeping your trades open even when the market spikes against you. Nadex is completely brand new with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com. Or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock and option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit TFNN.com.
The Path of Least Resistance is David White's daily trading newsletter, and if you're looking for active trading ideas, then now's a perfect time for a 30-day free trial to this powerful daily trading advisory service. David uses his years of trading experience to offer his subscribers his trading ideas each morning in his Path of Least Resistance newsletter. Using a combination of equity trades along with options, David keeps his subscribers up to date with all pertinent market information with intraday afternoon updates when warranted. Don't miss out on this great chance to get a 30-day free trial to David's daily newsletter, The Path of Least Resistance, with no obligation to pay anything. David has been delivering solid recommendations for his subscribers recently, and if you'd like to see the type of newsletter he delivers every morning, then visit the front page of TFNN and you'll find The Path of Least Resistance under Trading Newsletters. For all the details and to start your 30-day free trial today, log on to TFNN.com now.
No matter where you listen to TFNN programming, we want you to know you can always access your favorite shows on demand through TFNN.com. TFNN airs live programming every market day from 8 a.m. till 6 p.m. Eastern, and you can view each program by accessing Tiger TV through our homepage. We even have an easy link for all mobile devices, including iPhones and iPads, located at the top right-hand corner of the TFNN homepage. You can use your smartphone to view Tiger TV, but if you don't have a mobile connection that can keep up with streaming live video, then you can simply visit TFNN.mobi in the browser of your smartphone for live streaming audio of all of our programs. The mission of TFNN is to educate our audience directly and interactively through our interactive website and radio call and talk shows. TFNN is able to teach all levels of investors the technical skills needed to trade in today's marketplace. In order to get the best information possible, TFNN has assembled the most respected financial minds in the country to provide the most current news and comprehensive advice available. TFNN.com, educating investors. This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Okay, we're back, folks, and I believe we have our first guest on the line. Mr. Z, are you there?
This is Mr. Z, Larry. Good to speak to you.
Good to speak to you, John. How's the weather in Philadelphia today?
Oh, we're ramping up in the springtime, so things are definitely looking up.
This is good. So the snow will be gone by July 4th or so, right?
We hope so.
What can I do for you, my friend?
I wish you well on your improvement in your voice. So I wanted to relieve your speaking just a touch. Larry, I wanted to just ask a very specific question on trading the S&P 500 and the futures, the ESM contract. Now, you've made a key point as far as timing and cycles are concerned, that last week's low held the March 11th key time frame low, and now we're bouncing. And that combined with cycle studies that both you and Bill Ehrman had spoken about at length previously, coming in mid to late April, and combined that with the seasonal pre-holiday strength that is typical and upcoming end of this week. Given all those things, now that the S&P has bounced off of 2033 last week, and we've gotten up to 2078 right here, we're right about there now. And the Fib 618 mark is exactly 1 point higher, 2079. Would you, as a trader, take a shot at that Fib number, or do those time cycle factors persuade you to just stand aside on that idea?
Well, I would take a calculated the risk at that point at 2079, because the risk there would only be about 5 points at the maximum. But frankly, I don't think it's going to work for a couple of different reasons. One is the fact that that low is held on March the 11th, but look how strong we are today. You'd have to be preparing for a big reversal today in order to get a lot of profit. The only pullback we've had in the S&P since early this morning has been 7 points. So I would rather wait to see what happens. And John, you know how bearish I am long term. Just short term, it just looks like it wants to go higher. That's pretty much what I think. But at 2079, I mean, you're not risking very much there, because that 786 is the last hurrah that it has.
Right. Very good. Wanted to turn the conversation, if I could, to the current one currency market, the euro in particular. Larry, you had over previous weeks had made a significant point that when the euro broke the 113, 112 area, that as far as you could see, the strong target, the strong, maybe even a magnet, if you will, would be somewhere down near par or 99 on the euro versus the dollar. Now, having said that, last week the euro popped up for the second time to the 110.5 mark. My question, given that it popped up, made a little double high, combined with your bigger picture work seemingly targeting 99, do I assume correctly that as a trader you would have shorted that, and you're looking for all pattern setups to continue to short this thing?
Absolutely. And John, the way that it did it was, you mentioned that 110.55, and I'm sure you'll know this, but the first high was 110.50, and then about 4 days later it came in and hit the 110.55, and then just immediately broke 150 pips, which told you the significance of that resistance level at 110.55. I personally don't believe that we'll get this euro any higher than 111.50, which is the old 61.8 number,
right,
going back to early March, early February, and so that's why I would think that's going to keep it. But boy, this chart has so many things telling you that it wants to go to 99 in the euro versus the U.S. dollar, that it's pretty hard to make a case for a bullish bottom in here in the euro.
Indeed. Good. Thanks for sharing that thought. Larry, one last thing. I know that Sarah trades quite a bit herself, and given that she has got family in China, and the two of you go there from time to time, I want to ask the question: are the two, is Sarah or you, have you been trading the Shanghai stock index from the long side? And if you have, what do you think of it now?
Well, we don't trade the Shanghai index. Sarah happens to be in Hong Kong right now. In fact, she was trading this morning when I chatted with her earlier. Of course, it's nighttime over there now. It's about 12, almost 1 o'clock in the morning. So she's done for the day. But the Shanghai index is pretty hard to trade. Even if you're over there. I mean, you can do it. You have to have a Chinese account and stuff. They do have an ancillary one on the Hong Kong exchange, but the liquidity is nothing like what we have here. 2 years ago, when they were just opening the new exchange in Shanghai in their 100 floor building, the big skyscraper. I was invited to speak over there, and Sarah and I went into onto the exchange floor and saw just a technical marvel. It looks like something out of Star Wars, but there were not many people in the room. I mean, it was a lot of stuff ready to go, but not really very much. I'm sure you can trade it. I know it trades well off the numbers, but we've got so many other things to trade. You've got the euro and the pound and the yen that'll keep you busy enough. Why get involved with something that has not anywhere near the liquidity that you need to making a living at it? So that's the primary reason. It's just that it doesn't have the liquidity, and the access of it is not easy. I mean, you don't want to be trading all night long, and if you want to trade the Shanghai, you're going to have to be up when the Shanghai is trading, which is in the middle of the night for us.
Yes, indeed. Larry, thanks so much for that comment. We do appreciate it.
John, I have one other question for you. We've got the crop report coming in tomorrow, start of the growing season. What is your feeling on the grains? I know you've had these things nailed to the wall for the last 18 months. Where do you see them going right now, and where do you stand?
Two things I can share with you. Soybeans, I am frankly clueless as far as what a good trade is. The November contract is down in the 950, 960 area. That could go either way, so I don't have a strong view, and hence I'll stand aside on that one. On the D's corn, I do have to share this with you, Larry. Corn, if you look at your weekly charts on corn peaked up over $8 in the drought-stricken year of 2012, got down to $3.20 last fall, rallied up to $4.20, pulled back. There, I just can't help but think on corn, the bear market's done. The first rally up completed back in December with a nice Gartly decline down into January, February. And, of course, the price direction for, corn from now right in through, summer, of course, is going to be how many acres are planted and then what's the weather going to be. And, of course, you and I don't know that, and that could tip the scales either way. But we've got this report where stocks come out, stockpiles from last year, combined with the acres estimate, but recall that's only an estimate. That would be subject to change going forward. And what I can tell you is if I think there's going to be any surprise in corn, I'd bet the surprise would be higher with less corn acres planted. And in the case of the wheat market, I've been trading that from the long side. I got out of that a week ago. I must confess, last Thursday there was a big, wide-ranging decline bar, and it went right to the Fib 618 on the Kansas City wheats. When it fell down, I was telling myself, buy it right there, John, at the 618, but I hesitated, did not buy it, given the wide-ranging bar on that Thursday, but it turned out that was a low right there. Now it's all the way back up. It's just rallied 30 cents in the past 2 days. And there's drought going on in Kansas, unfortunately. So so wheat higher, and if there's a surprise in corn, higher, but, of course, it's Mother Nature from here. So those are my 2 cents.
Well, thank you very much. And I know it's sometimes when those numbers come down to those fib points, they absolutely scare you to death. And by the time they've hit, they don't let the train get out of the station fast enough, and you do miss them sometimes. So, that's the main thing that you have to be worried about, I'm sure.
And just that Kansas City wheats setup that I just described. The identical inverse of that is that E-mini is the S&P futures, and that's why I asked that question of you earlier to start off with. In fact, I'm inclined to just take a shot at the short side at that 618, just using the numbers. But there we go. Larry, thanks so much. Do appreciate it.
Thank you for calling in, John, and I hope to talk to you again soon.
Very good. Bye now.
You bet. Okay, folks, since we're talking about, we were talking a little bit about the Shanghai market and overnight markets and stuff like that, I wanted to share with you this is the German DAX, which is very, very heavily traded, both here in the U.S., but most importantly in Europe. And as you can see here, I posted in a line chart of the 60-minute chart on the June futures, and you can see it makes a perfect ABCD Gartly pattern down there, just a tad below the 61% retracement. And now we're very, very close to the highs that we made back on March the 13th. Now, the market was making a high on the German index when we're making a low on the U.S. index. So you've got to trade these separately, folks. You just can't say, well, the German market's going up, so I'm going to buy the S&P. That's not a very, very smart thing to do. John Murphy did a lot of technical analysis work with, the correlation of intermarket spreads, and you certainly have to look at each one separately. That's the only way you can really, really do this. So that's the key to watching this particular intermarket spreads. You just don't want to get involved. The same thing is true with currencies, and I wanted to bring out something that a lot of you folks, we had this big thing in the Swiss franc that happened a long, long time ago, way back on January the 15th, and if you take a look at the chart, you'll see that the Swiss franc gained almost all of it within about 50 pips of the whole move down. So that was basically a scam, in my opinion. I'll stick with my feeling on that. But I mean, you stop and think, the market dropped. In one day it went from 102 down to 74, which was $28,000. Yeah, $28,000 in a matter of about 15 minutes at the most, and the last 5 minutes was just absolute chaos because it went from 74 all the way back to 87 and then continued to rally up to the 102. So you've got to be careful. That is an outlier event. You just don't see anything like that. And the fact that it came back and gained almost all of its power back is really really quite amazing, because what the Swiss did was to decouple themselves against the euro, and the euro came straight down, and yes, the market still held up at that point. So it's very, very interesting in that market. So we'll have to wait to look at it. Now, I posted the chart of gold into the room because you can see that we made that 50% retracement that we had back in about 2 months ago, and we backed off. Now the silver has been much more bullish. It stopped right at the 61% retracement, and that's what we'll be looking at here. So, we've got a caller in from New Jersey. Rob, are you there?
Yeah, hey Larry, how you doing?
I'm good. Now listen, we might have to pay a few bills here, but if we do, stay with us, okay?
Okay, well, it's a great show. I had a question about, you said in around the third week of April, there will be a top in the market, or there will be a cycle date. Is that like a big date? Like you think for a year that'll be the top, or is it a minor date?
I only listen to a couple of people. There's about 4 or 5 people that I listen to over the years. Bill Ehrman out of Nashville, Tennessee, that does the Ehrmanometry and wrote a book about Ehrmanometry. He's been the best I've seen for timing of anybody, and he's got a big cycle date towards the end of April. I'm not sure the exact date. I know it's in the 3rd or 4th week of April, and he stuck by that for a long time. The thing about his work that is so unique is that when these numbers hit, and they go above those numbers, he immediately says this market is, not topping, it's going higher. And he's been saying that for quite some time. I had an interesting talk with him over the weekend because of the fact that we made a lower low in the S&P futures. We matched the S&P futures low, but we made a lower low in the NASDAQ from March 11th, and we made a lower low in the Dow. And I'll repeat what he said to me after this break. Can you stay with us, Rob?
Yes, thank you.
Okay, got the Dow on its high, and we'll be right back after these few words.
Today, it's hard to tell if the economy is coming or going. Regardless, I want my money going in the direction I choose. If that's your stance as well, then you want to know how Everbank can help keep your money thriving just the way you want. Is growing your money a priority? Everbank is committed to a yield pledge promise to pay high yields on your checking, money market, and CD balances. Looking to diversify? Everbank ingeniously developed accessible ways to spread your money around the world into foreign currencies and even non-FDIC insured metals. And when it comes to your wealth, they bring a highly experienced and global perspective to help you manage it. Everbank's financial philosophy flies in the face of the status quo. They believe your money's performance should not be determined by today's economic circumstances, but by the drive to rise above them and create opportunities that favor your objectives. If that excites you like it does me, visit everbank.com/TFNN to find out what they can do for you. Again, that's everbank.com/TFNN. Visit them today. Everbank is a member FDIC and equal housing lender.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to The Gold Report, an $85 value, visit the front page of TFNN.com today.
David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
We're told to follow our passion and everything else will fall into place. I hope that's what each of you are doing each and every day. Hi, I'm Steve Rhodes, host of the Money Master Show at TFNN.com, and my passion for technical analysis is what led me to the most fundamental discovery in pattern recognition, the Rhodes Momentum Indicator, market scanner, and trading strategy. A set of tools that identify the momentum and power of the trend, the likes of which have never been seen before, for every market and every time frame. Yes, folks, the trend is your friend, unless you're on the other side. New to technical analysis? This is the place to start. And experienced traders take advantage of the trend like never before. Experience the power of the Rhodes Momentum Indicator each day, available to subscribers of my newsletter service, Mastering Probability. I guarantee your satisfaction for the next 30 days unconditionally, so there's no risk to you other than being on the wrong side of the trend. Mastering Probability, available on the homepage of TFNN.com. And folks, live with passion.
This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com.
Okay, we're back with Rob from New Jersey, and we were talking about the work of Bill Ehrman from Ehrmanometry in Nashville. Rob, basically what he does is that he looks at mathematical numbers going back into the late 1800s, and he goes back and he does these correlations to see, you know, where the market should be at that particular time, whether it's bullish or bearish, and he doesn't know whether it's going to be a high or low at that time. He just knows that that is going to be a very, very key date.
Okay, was he thinking April's a major date? Like, could be the top for a year or so? Or?
He told me. He told me Saturday. We were chatting Saturday morning, and he told me that, and the last date that he mentioned that was so important was March the 9th of 2009. He was, of course, that was an easy one to see because, you know, it was making a 3-drive pattern and everything in the stocks. But this one, in April, he said is the biggest date he's ever seen, and this is going back over, I think he said 95 years, maybe even longer. But he says it's just so big that you know, it'll be an event that could be. Now there's a possibility that maybe it's going to be a bottom. I don't know, but if it's at a top, then we'll have to wait and see. But as we get closer to that date, I'm certainly going to have him back on the program because his work it stands by itself. I've been doing this stuff for a long time, and no one can do what he does. I certainly can't. And you know, a lot of these things are related to the astrological things that I look at, like the one on March 9th it was, but this one in April.
You mentioned there was a date in April 20th, right?
Sometime, I don't. It's towards the end of the month. That's all. It's all. He hasn't even told me the exact date, so I believe it's towards the end of the month. And I don't let those dates affect my trading too much because I'm looking at things on a half-hour chart, and if I can see a pattern, because I know the market goes up and down, I'm going to be looking at it. But for 401ks and investment survival and stuff, this is one we really have to pay attention to because, you know, Isaac Newton's laws have not been repealed as of yet, and you know, we have such bullish consensus as high as it's ever been. We got margin debt as high as it's ever been. We got corporate debt that makes margin debt look like a bear market. There's so much corporate debt out there with 7.7 trillion. Then we've got the 4 trillion in quantitative easing. This is a debt bubble. You know, when that comes, it's going to be bad. That's all we know.
Okay. Thanks very much. You've been very helpful.
Well, thank you, Rob. I appreciate you calling in, and hope to talk to you again soon. Why don't you call in towards the end of the month, and we'll see end of April, and we'll see where we stand.
Okay, great. Okay, bye.
Okay, you bet. One other thing about the shortened week this week, with the markets closed on Good Friday, you know, the day following a holiday is going to be a very positive bias day. I think this one has a bias of about 70%. 7 out of 10 times the market will close higher the day before the Easter holiday. The highest of all those is, of course, Thanksgiving. It's also a big one, and Christmas is also another big one, but Thanksgiving is the best. Christmas and Easter are good, but not nearly as good as the one in Thanksgiving. So we'll have to wait and see how this is going to turn out. One other question someone's asked me about the bullishness in gold and silver. I posted the gold chart into the room, and I'm looking for a Gartly pattern to form somewhere around the 1170 to 1150 area. I'd like to see that take about 5 or 6 days. That would bring us into early next week. So early next week, I'm looking to be a buyer on gold on a pullback. So live every day in an attitude of gratitude, and may God bless.
Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns, as well as market trend calls. Thus was born the Chapman Wave sequence. Using the Chapman Wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.
You're watching Tiger TV.